Well, there it is, ladies and gentlemen. The NASDAQ and S&P 500 are absolutely skyrocketing at the time of recording this video. 7% for the NASDAQ, 6% for the S&P 500 off of the news that the Trump administration is looking to pause tariff developments for 90 days going forward. And a quick congratulations to those of us who prevailed, stayed bullish, stayed to our convictions during all of this fear. We are getting rewarded on a day like this. My portfolio is having the single best day I've ever had in my trading career, up 6% in a single day. Between the NASDAQ bouncing back and the sharp move higher here today on gold, this is just a true testament to why sticking to a system and staying systematic in what you're doing matters so much. Trump authorized a 90-day pause on non-retaliating countries, and that the 90-day pause applies to reciprocal and 10% tariffs effective immediately. At the same time, just thrown in there casually, we're raising the Chinese tariffs to 125%. Now, before we get ahead of ourselves, let's take a look at the NASDAQ. We are still in what is a overall downward trend. And I think that although this is incredibly good news in the short run and could be signaling that we have officially found that bottom, it's too soon to really call, because if you've been watching my videos like the one that I did earlier today before I had to make this emergency video, the idea here basically is still we need to see some higher highs and higher lows. Let's stay true to our basics. Let's not get too excited with this headlines, although admittedly it is a pretty incredible move higher. In fact, the biggest one-day up move that I've seen in years for the NASDAQ, up 8.5%. This is crazy. I mean, this is the type of market that we're in. Everyone has been positioned bearish. The crowd has been bearish, and all of a sudden, boom, here comes the good news. And you can just see all of a sudden how revealing this market really is, just how bearish everybody has been. And although this does not guarantee that the low is in, we could still have more downside to come in coming days or weeks. I do still want to just say that I feel pretty vindicated right now that I've been talking about don't chase sell-offs in markets. I feel pretty validated in my thought process on that recently, because again, we've been saying on this channel day in, day out, despite many criticisms on my comment sections, people have been very bearish and very outspoken about it, and that's fine, but I've been very cautionary about chasing things to the downside for this exact reason. Everybody, it seems, is bearish in this market. The put to call ratio has been signaling that on this channel for several days now, as we've reached some incredible extremes of pessimism in the markets. And the markets, as I say often, they love to play gotcha. When everybody's convinced it's going to crash, something like this just happens to happen. And an incredible burst higher here since we even started recording this. We're almost up 10% on the day on the NASDAQ. Absolutely ludicrous. So how do we play this going forward? Well, again, in my portfolio, I am long heavily in tech stocks that I like for the long term. But from a trading perspective on the NASDAQ, I am waiting for a sign of a breakout through some levels of resistance, perhaps something like this, some higher lows, higher highs, before I can look to trade this on a material basis and say that a true low has actually been formed in the markets. I'm not too interested in catching the bottom in terms of a trading perspective. Like I said on my channel many times, I've been adding to my stock portfolio for the long term, but I do think that we have to be cautious here. This thing could still escape back down to the downside before the end of the week. This thing is very, very volatile. From a tradable bottom, what I mean by that is a tight stop loss attempt to move higher. I'd be looking for a key breakout at the very least above this 19,200, and then looking for signs of a higher low. That would give me a material area, kind of a flooring on this market, if you will, rather than just kind of a V-shaped move that could, of course, continue to push lower. But obviously this move is based around a short squeeze type of environment. You can see the investor sentiment survey for over a month now has just shown that pretty much everybody, the crowd mentality, has been short the market, it's going to crash. And so when you get news like this, many people are on the wrong side of that and are massively covering short positions, selling back their puts that they bought, and so on. The VIX is dropping an amazing 33% here today. Dollar index is pretty flat on the day. Gold continues to hold its gains, and I do still like this trade that I'm in quite a bit. I am looking to trail a stop loss if we can get a pushback through those all-time highs. But right now, the story really is focused on the indices. Here's a list of the stocks that I own, and my God. Tesla's up 14%, Robinhood's up 18%, Apple's up 12%, Amazon up 8%. This just shows, again, how the market has been positioned. It's been positioned for the worst case scenario, and then something less than the worst case scenario happens, and the market has a head spinning rally. So just as a reminder for those of us who have been patient in this type of environment and not given into fear, this is why we do what we do the way we do it. When markets are crashing, it is very easy to give in to the doom and gloom and focus on the negatives. Whereas again, I've made the majority of my money in the markets over the years has been spotting those rare opportunities when sentiment gets so extreme and actually looking to be contrarian on a slow and steady, no leverage basis. So how do we know if we can trust this bounce back in things like the S&P 500, which is up 7% on the day? How do we know we can trust this? Well, again, these moves can happen so fast. Tomorrow we could have a 7% down move. So how do we know? Well, same thing for the NASDAQ, for the S&P 500. I'm looking for new higher lows and higher highs. The trouble to these rallies, the last time it was very weak rally back. I thought it had some bearings to it, but then we accelerated to the downside with a very high VIX. What I'm looking for in this move higher would be a VIX to actually chill out further from here. We're still at a 36 VIX. If we can get back down to like a 25 or lower VIX, that would be a good sign that perhaps a short-term low in the market is here. Chinese stocks are also up 4% on this move, and you see stocks globally loving this news, up 5% for the Japanese Nikkei, the German DAX up almost 6%, the Russell up almost 7%. Copper is screaming higher, oil is screaming higher, silver is up, everything is rallying. Now, I would just urge caution here too, because now people are going to make the same mistake in the other direction. What I mean by that is now that markets are clearly ripping higher, I think that people are going to make the mistake of assuming, oh, this is just good news. We're just going to go straight back to the highs from here. And I also think that's a really dangerous way of thinking. This market is clearly a back and forth, violent market move, and we could very well see a retest of structure again. Although I do think that this kind of headline gives us some good solid footing, especially if we get further rate cuts from the Fed in coming months and we see economic data hold up. This is the type of market rally that I think is sustainable and that could take us out of this downward spiral we've been in. So tactically, I am bullish from here in terms of my stock long-term positioning, but I'm waiting for a sign of break above key resistance points to give me a price action technical short-term trade to the upside. Bitcoin's up 6.6%, Ethereum is up 8%, Dogecoin up 11%. And interestingly, bonds are actually bottoming out in response to this, and yields, while they were moving higher this morning, have given back a little bit of those gains. Dollar yen did a complete reversal here today, moving back higher. My Kiwi dollar trade is back in the positive now. My euro dollar trade is still doing pretty well. Still looking to take profits if we get a move up to 1.12. The Japanese yen, which has been a safe haven recently here, being sold pretty heavily today on this news. And the question now too about the fundamental tariff side of things from here is, has the damage been done in all of this? And I think that we may have actually gotten away with this. What I mean by that is tariff announcements don't send us directly and imminently into a recession, right? The results of tariffs, if there are no concessions, no negotiations, no improvements, could send us into a recession. That's been the debate here recently. Today's 90-day pause gives us some time here to perhaps negotiate more deals, to perhaps get away from this recession certainty that seemed to be creeping up all across Wall Street and actually work our way through this as a global trade network. Now, of course, China seems to be left out of the negotiation with 125% tariffs being slapped on, but perhaps this 90-day pause gives us time to discuss with China and gives us time to discuss with many other trade partners who seem willing to negotiate with the United States but needed time. Personally, seeing this 90-day pause, this feels like a big relief to me as well. You know, I do think that most people can agree, like, okay, if the US has a huge trade deficit and also provides a huge amount of spending for the world, maybe it's fair that they want to negotiate trade. But I've been pretty critical of this idea of just sweeping all aggressive tariffs being a really devastating thing to economies. So seeing this 90-day pause to me looks like, okay, we might actually have time to work through these things and come out okay on the other end, rather than this big uncertainty the market's been dealing with. Now we have time to calibrate, and I think the market may continue to rally off of that. So I am bullish on this market. I think that it comes down to, however, where we have to be careful on this is this coming week or the next few days, right? Tomorrow we get inflation data, and so on Friday too, right? We get CPI tomorrow and we get PPI on Friday. We want to see cooling inflation data. We're expecting 2.5%. Let's hope that we get something like that or below. That would continue to help the Fed story to potentially ease interest rates this year as well. You get those two things, a Trump put and a Fed put, and I think you're talking about a market rebound that could be sustainable. But too soon to call. I don't want to get ahead of ourselves. I think we need to see some higher lows, some higher highs, and some breakouts here before we truly say, okay, yeah, we're all clear. This is definitely great news and in the right direction, but let's watch how price action forms for the rest of the day and the rest of the week to see if we can get a breakout as we've been discussing in today's video. The Edge Finder, which is a software that I use regularly in my videos, is currently 40% off for our biggest sale event of the year. If you have not taken advantage of this opportunity to pick up a copy at these low prices, don't miss out on the jump in price like many people did with the indices. Pick up a copy of the Edge Finder today, 40% off of its highs with the promo code that you see on the screen, YTVIP, or chat directly with our support team using the first link in the description to get an extra 5% off the tool. Dow Jones, NASDAQ, and S&P have been moving in lockstep. That's very rare.
And even equal weight is no better. Like, so there's just not, like, look, there's not a lot of places to hide. This proves it right here. You know, if somebody wants to tell me, oh, this is about rotation, it's like, bullshit, it's about rotation. This is a crappy market and nothing's good. And the only way you're going to hide out is if you want things to hurt less, then hide out in consumer staples and stop worrying about it, because it'll be fine. But it's not going to necessarily be a bull market. It's just going to be preservation of capital. You want to hide out in utilities, it's fine. It's not going to go anywhere, but it's going to go down less because it's way less correlated and way lower beta. You want to hide out in healthcare. I mean, healthcare might have some surprisingly good price appreciation because
you get some dividends.
Sure, all of them get dividends, but you pay tax on dividends. But I'm saying, like, utilities aren't going to do anything price appreciation wise. Maybe they will, maybe they won't. But healthcare has an interesting mix because there is an AI element to healthcare. It's one of the fastest growing sectors in the world. It's like our baby boomers that need this care. I mean, the healthcare costs are just rising like crazy. The need for right now, the need for nurses, doctors, people in the field. My concern is over the next 5 or 10 years, AI starts doing more of this. Like, think about all your symptoms put into an AI machine, and it's basically the people cares, like HR, maybe like one HR person to run a department to handle all these, like.
Another one, Chris, with that same line of thinking that I really like for the long term is medical device companies, Medtronic, Intuitive Surgical. I mean, some of these companies, like Intuitive Surgical, is very, very expensive stock. But what you're saying, the whole medical world is like ripe for AI to seriously level up humankind. I mean, that is some really practical stuff. Healthcare was a big favorite for me personally going into this year. Now, I got to disclaim, if I was really smart, I would have had most of my portfolio, and I did not. But I did have plenty of healthcare stocks going into this year and continue to like that as a potential outperformer. So far, it's doing pretty well. But what you're pointing out here with this breadth thing here, right? Just basically everything moving together. I think it's reasonable. I've been talking about this, Chris, and I've heard you leaning more cautious here recently too. With this big kind of market downturn, it's also fair to acknowledge bounces can be very violent, right? I mean, we had just a massive turnaround in the last 2 days, and then of course down again. And then what you're pointing out there, everything kind of uniformly down. Does that give you like the theory that like, okay, probably looking a little oversold in the short run, maybe more pain ahead? Or do you think you ignore this trend this time? I feel like you kind of have to look at this thing and say, look, it's had a great track record, innocent until proven guilty.
I think so. I've been looking mostly on like the weeklies and monthlies because it's so rare to see them. But what I'm looking at probably on the daily is if I see a green close, I'm probably going to take a little bite. I'm willing to take a bite because, and all I need is like a 2 week to 4 week window, because that's usually about if we are in a bull rally in a bear market environment, then a 2 week rally or 2 week recovery could be surprisingly bullish. Like, and that's what catches everyone off guard is, I mean, if we clear this high here, Nick, if we clear 5260 here on the SPX, we could rip all the way up here to 5400. We could rip all the way up here into 5600. And it's going to catch everyone's, like, it's going to rip everyone's face off with how aggressive that is. And then the bears are going to be like, hey, that was cute. Now we're going to go right back down.
I was going to say, in 2022, look at what you had. You had some of these Maybe we can share my screen here for a second, guys.
Yeah.
We had just a violent down move, up move, down move, up move.
Double-digit swings the whole way for 2020.
And this move, that's 24%. Doesn't look like that, but it's 24% move up, right? And then this move was, 17, 16%. So I think that it's really important that I've just been seeing people who are now thinking, Chris, that the easy money is just being short. And I think that's such a dangerous mentality because shorting is inevitably, in my opinion, one of the hardest trades to get right on the indices because it's so short-lived, so sharp, and you can take profits way too soon. It's just very, very difficult to the windows are so narrow, but the profits are so big if you're right.
And this is the crappy part. Like, just like in 2022, which is that was a controlled, orderly bear market. But if you go year to date here, all this shows me is that there's no real safe place to hide. And right now, Nick, bonds aren't even offering safe haven either. We've had an 8% swing in TLT.
I have to ask you about that, Chris. I have my speculations, but I think China's offloading. I sent you that message this morning. I think China might be tanking or just closing out. I mean, they already had been selling bonds, but we might have accelerated that trend with what clearly seems to be like the closest thing to not firing bullets and starting a war, right? There's a straight up trade war going on. And so if we have, Chinese assets, we'd probably want to sell those. And the Chinese vice versa would be like, get rid of the American assets. We can't, that's super dangerous territory for us. And then meanwhile, we got gold shooting up today. So it's almost like, to me, the writing's on the wall that Central Bank of China has already been buying gold. We might have just accelerated that trade.
Yeah, it's true. I mean, right now, I just want to put this in perspective because right now it's like China's offloading, Japan's offloading. Maybe they are, but this is the reality. We still own like 85 to 87% of our debt. So the offloading, it sucks. I get it. But like, because we're watching, frenemies become enemies and allies possibly switch sides and alliances, maybe. Like that's what I think this is the worst case scenario. Like if we're getting worst case scenario, it's like we are going to be what Jamie Dimon said yesterday, which is, he had a great quote. It said, America first is fine, but America alone is not. Paraphrasing. But it's like, I mean, that isolationism is not going to be good for the US because we might find ourselves, like just yelling at the world and nobody's listening. And meanwhile, we're sitting here with like this ticking time bomb of debt that needs to be and you can argue for a lot of cases like something like this needed to happen. This is Ray Dalio's changing world order. This is the fiscal cliff, the fourth turning. Like all these things are out there. This is the fiat system really being stressed. And so, I mean, look, man, there's nibbles here for Bitcoin enthusiasts. There's nibbles here for Igor and gold bulls. There's people that like what bond king, I mean, like what's his name, Bill Gross, like PIMCO. Bill Gross, like he no longer works for PIMCO. Like bonds have not been easy and they've been like garbage in the portfolio. Like bonds are not good. Bonds have been in a 3 to 4 year drawdown. The only time they were rescued was that late Q4 rally in 2023, coming back from like another bear market, and they ripped up like 17% to finish positive on the year. But they have in a 4-year bear market. And
bear market, Chris, is lenient. I mean, they've crashed. They've completely done destroyed. Yeah.
So I just want to show this because like U.S. still owns its debt. And, the scary part is, yes, if all of a sudden the U.S. loses world reserve status or gets to get like knocked to world number 2, then maybe this changes. But I don't know. And it's like, I hate that I'm even thinking like so doom and gloom, but it's like, look, man, if this market, I do believe this. The financial markets are too big to fail in a way. Like there could be some restructuring, there could be some massive reset, but in some way, shape, or form, financial markets are too big to fail. There's too much wealth for the entire world. And you can see based on the price action from Friday last week to what we're seeing right now, everything is red. The whole world is red. And if anyone cares about the financial markets globally, they're going to find ways to figure it out. And it's not easy. Like it could come with a lot more pain, but it certainly comes with a lot more uncertainty. And this is probably one of the more annoying times I've had in my career. Like 2022 was challenging, but it wasn't this annoying because it's like, holy crap, are we just going to like, what's next? We go 20% and it's like, what's next? 30, 40? Like we just go all in one straight line. It's like, I don't think the market does that, which is why I kept emphasizing maybe this little like April 17th expiration. You're dealing with one of the most bullish windows in the markets, like seasonality wise from April, May, June, July, historically very bullish. And if
Well,
we can just survive this window to not do too much damage, and the market's priced in essentially what is kind of this, trade war. Trade war worst case has kind of been priced in. Now the next shoe to drop, like I said, would be earnings compression, which then maybe later this year is going to be jobs and labor if we have like a big September, December dump in unemployment. But I don't think it happens all at once. And so, but it's not out of the cards, man. Like, I don't know if 4,800 is the low in the S&P. I think that maybe it's closer to 45, maybe it's closer to 4,000. But I'm not going to sit here and trade that way right now. I just know that I've got hedges out to December and see what happens.
the thing I've been looking at the most has just been staying true to the put to call. Look at this thing.
Yeah.
But again, to your point, I thought the put to call ratio was high over here, and then boom, it just really took off,
Yep.
So
Yep.
crazy.
Okay. Yeah, that's one kind of the charts I'll be looking for. I'm going to try to find like if I can see that institutional levels are coming back in, like as far as like, and I can follow money flow. That's one indicator I can always use. I think it's CMF on TradingView. But if I go CMF and I'm seeing that institutions are, elevated while the retail crowd is dumping, that to me is showing that like real smart money, real big money is actually willing to step back in. That crossover to me is a pretty good sign that real money's come back into the market for a sustainable investment, as opposed to like short-term, net swings. And retail traders are typically always over leveraged and they're gonna get beat up the worst.
Here's one that I found really interesting, Chris. This is the historical data for the Japanese yen. Look
Okay.
at the yellow. The yellow is showing you the long percentage overall for contracts traded on the Japanese yen, institutional money. Look at how steadily before all this took place, there was just a buildup in bullishness for the Japanese yen. I find that just so interesting. We also saw that back in August, right as that kind of big yen strength came into the picture. Institutional money was building up, and then they deleveraged on that yen, and then now getting back into Japanese yen for the last few months, and which has been a great play here recently. You mentioned FXY, you're playing that. I mean, yen's been very strong recently.
I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.